Lesson 20, volatility. This is one of the most important lessons, so pay attention. What you will learn here: historical volatility, implied volatility, and memory of prices, what to make of volatility and volatility skews. The main probability we face in using the Black-Scholes formula lies in the volatility value to be given to the formula itself. If in fact, on one end, the underlying, strike, residual life, and risk-free interest rates are observable values, volatility is the only parameter that is not based on objective but subjective criteria. The volatility incorporated in the options prices is not in fact that one based on historical values, but rather the one which expresses the expectation of the future behavior of the underlying. The first, called historical volatility, is usually calculated on the basis of daily price returns over the last 20 days, rescaled on an annual basis. Here the procedure: the historical series of closing prices is taken, and the following steps are performed on it. Calculation of daily returns given by today's close divided by yesterday's close. Calculation of the natural logarithms of these returns. Calculation of the standard deviation of the natural logarithms of the returns of the last 20 days. Multiplication of the deviation found for the square root of 252, conventionally the number of working days in a year. Equivalently, you can determine the returns as a gap between two consecutive closes divided by the first of the two, and then calculate the standard deviation of these values without having to go to logarithms and multiply the result by the square root of 252. You get to a very similar result, not exactly the same, but very, very close. Let's look at an example based on real data. Here we go. I took the data series of the stock advanced micro devices over the last 45 days. It doesn't matter. What we have to do is calculate the daily returns. And of course, we need to go to the second day. So to be able to compare the two closes, we do this divided by this. And here we have all the daily returns. Then we have to pass to natural logarithms, not log, equal to, my platform is in Italian, so logaritmo naturale of this parameter here. And then we can calculate the standard deviation of the last 20 natural logarithms: 2, 4, 6, 8, 10, 12, 14, 16, 18, 20. And we multiply it times the square root of 252. And if we look at it on a percentual basis, it means that stock has 32.3% of historical volatility on November the 4th, 2019, looking back 20 days. I could have reached the same result, more or less, proceeding this way: closing of today minus closing of yesterday, divided by closing of yesterday, and applying it to all data, and then picking the standard deviation over the last 20 days and doing the same. You see 32.6% rather than 32.3. Very similar, not exactly equal, but very similar, and an easier way to calculate it. In the following chart, we can see the historical volatility of the FTSE index between the years 1997 and 2015. As you can see, it's a very nervous curve. Okay, the historical volatility can change significantly from a period to another. It usually stays most of the time between 10 and 30%, more or less, but sometimes we have some spikes in the values of the historical volatility. And if we put on the same chart both the historical volatility and the price, the blue line in this situation, what we can see is that any time that the market falls, the historical volatility spikes. This is a very common behavior in the markets. When the market falls, historical volatility spikes. Every time we see a spike in the historical volatility, we can see the market has been dropping significantly. What emerges from the analysis of the figure on the previous slide is that volatility is generally inversely correlated with closing prices. In increasing trends, volatility tends to decrease. In decreasing trends, it tends to increase. This is generally true for stock indexes, while on single stocks, different dynamics can be observed, sometimes positive correlation between prices and volatility. Let us remember what we have seen when speaking of the normal distribution. Volatility, calculated as the standard deviation of returns, is a measure of risk. The greater the value, in fact, the greater the magnitude of price fluctuations, and vice versa. If you're looking at past fluctuations, then the historical volatility rises when the previous price ranges have already expanded. But in the world of options, we have to look forward. That is, we have to look to the expected price ranges. For option sellers, volatility is precisely a risk measure of exposing oneself to the possibility of a strong price movement beyond the sold strike, which leads to heavy losses of money. If, therefore, the volatility is high, the premiums must be greater to compensate for the greater risk perceived. The limit of historical volatility is that it represents a photograph of the past, which may not necessarily be taken as a projection of the future. Since the options must form a price that takes into account the probabilities of future events, historical volatility cannot, by definition, be a correct measure of expected risk. What volatility should then be used in pricing the options? Here a problem arises, because the volatility to be used is not something observable, but rather a quantification of an expected future risk. How do you do it then? Ultimately, it is the market that implicitly decides which value of volatility can be fairer, through the dynamics between supply and demand. If the perceived risk increases, the prices of the options increase in turn because the sellers move their sales offers upward. The expected future volatility is therefore discounted within the option price, and it is called implied volatility. It goes without saying that implied volatility is more reactive than the historical one, as it tends to discount the expected future price trends in terms of nervousness in advance. Therefore, if historical volatility tends to show increasing trends in the face of opposite moves in prices, the implied volatility shows the same dynamics but with a certain advance. If therefore the historical volatility increases as a result of the market turbulence, the implicit one increases when the market fears a certain turbulence is coming, so in advance. Not by chance, the implied volatility indices available on the markets, such as the VIX for the S&P 500, the VXN for the Nasdaq, or the VSTOXX for the European market, are often called fear indices. As soon as the market perceives a greater risk on arrival, reflects it in greater values of implied volatility. Given that the implied volatility is not directly measurable, how do you then use the Black-Scholes formula to estimate option prices? The answer can be confusing, but I already anticipated it in the previous lesson. But this is how things are. The Black-Scholes is not used to calculate the prices of options, but rather to determine, on the basis of the market prices of the options, their implied volatility, because it can provide us with the indication of market sentiment regarding the future risk of the market itself. Implied volatility and memory of the market. This is one of the most important concepts. Since where there is no risk, there is no return, knowing that a certain market is about to become volatile is nothing more than a signal that there will soon be profit opportunities. A question that arises is whether the implied volatility is totally unpredictable or not. In fact, the problem here is very complex, but it is also quite interesting and intriguing. In fact, how does the market formulate expectations about the expected future degree of nervousness of a given market if it cannot be based on statistical concepts supporting its own fears and expectations? And here we go back to talking about the memory of the game. What happened yesterday, what happens today, tends to influence what will happen tomorrow. If this were not the case, it would make no sense to do technical analysis because the psychological impact on the market of current and past events undoubtedly influences what will happen tomorrow. It is obvious, however, that to what we already know today, tomorrow we will also add what we know tomorrow. So the question is whether it is just this new information that we will only have tomorrow that will be able to move the balance needle in one direction or another, or if there are also other dynamics that come into play. Well, historically, graphs in hand, the implied volatility tends to have a mean reversion behavior, that is to say, it periodically returns towards the average. The excess of volatility usually tend to fall back relatively quickly. But there are glaring exceptions to this rule. In fact, there are implied volatility thresholds beyond which the market tends to lose control and volatility generates more volatility. These concepts generate distribution tails much thicker than it emerges from the normal model, a concept that we will come back to when we will talk about non-directional strategies. I already told you that the normal model is just an approximation of reality. We are getting into some more details, but we will see it much more when it will be the right time. In essence, the concept is that in extreme situations, risk can become truly out of control. If it is true that, however, even the worst excesses tend to fall, the problem is that you can find yourself being thrown out of the market before the excess falls back to normal. In summary, therefore, risk management is a primary concept in a world of options because, as is known from a statistical point of view, short selling is more rewarding than buying. But it also exposes to risks that must be maintained under control all the time. Two important concepts regarding implied volatility. First, it only affects the prices of vital options, while at maturity it has no effect. Furthermore, the expectation of future risk may suddenly change both in one sense and in another, depending on new information that comes into play from time to time. The implied volatility is therefore not a forecast of future volatility, but an indicator of the perceived future risk. Not, therefore, how much the risk will be tomorrow, but how much it is expected to be, how much it could be. And we will return to this concept shortly. How to determine the implied volatility then? As previously stated, the Black-Scholes formula is used to determine the value of the expected future market risk embedded in the volatility implicit in options prices. Here, however, a problem arises because the Black-Scholes formula cannot be inverted. That is, volatility cannot be expressed as a function of price using an inverse of the formula. So you have to proceed by trial and error. The linear programming mathematical procedures for this purpose are different, but one of the most popular is the one based on the concept of bisection. Everything will be clearer by proceeding immediately with an example. Let's suppose that at a certain time, the FTSE index is quoted 22,000 points and the call strike 22,000 points with a 30 days maturity is 500 points. The annual risk-free interest rate is 0.01%, negligible. By entering all these parameters except for the call price above, the price of 500 points is not obtained in the Black-Scholes formula unless an implicit volatility value of 19.87% is included in the formula. How do you get this value? We begin by considering two extreme values of volatility that are certainly unreasonable, for example, 0.01% and 200%. What is expected, compatibly with the dynamics of the prices discussed above, is that with a volatility of 0.01%, the Black-Scholes price will be much lower than the expected, and in fact, it is 0.4, and that with a volatility of 200%, the price is much higher than expected, almost 5,000 points in fact. Now, let's try to gradually get closer, by trial and error, to the true value of implied volatility. And to do this, we consider the semi-sum of the two initial volatilities, meaning the center of gravity of the interval, let's say 100% for simplicity, and recalculate the theoretical price with the Black-Scholes formula, 2,508 points. Now, since we have halved the volatility interval, to proceed, we halve it again. But first, we need to determine in what direction it makes sense to proceed. Since we know that even 100% volatility is too high, we halve the interval in the lower half of the range. That means we take 50%. The theoretical price results 1,257, still too high. Therefore, assign that the real implied volatility is even smaller. So we add once again the interval downwards and try 25%. And the result is 629 points. Still too high, so we halve it again and try 12.5%. And finally we get to a price lower than the expected one, 315 points. Now we know that we must increase volatility because the theoretical price for the first time is lower than the real. Then we halve the interval once again, but this time upwards, and we try 1875, and we get a theoretical price of 472, and so on. Therefore, the volatility is somewhere between 1875 and 25, so we halve the range again and try 21.875, and we get 550, and so on, and so on, and so on. It is not difficult to prove that generally in 18-20 steps, you always get an implied volatility value such that the theoretical price is so close to the price observed on the market that it makes no sense to proceed further. This tolerance is arbitrary, of course, but it can be set at 0.01% without perceptibly expanding the computational time. So this is a very efficient way to reach very fast the expected value of the implied volatility. What is all of this for? The historical volatility, if calculated over different time horizons and then compared, can be used to analyze the current market and compare it with its history, thus identifying expansion and compression phases, useful for those operators who are looking for volatility breakouts to enter in position. In the same way, it is possible to calculate the implied volatility over different time horizons, typically different maturity options, which can be very useful for the creation of particular strategies, calendar spreads. Furthermore, comparing the implied volatility with the historical one, it is possible to formulate expectations of future market directionality, taking advantage of the relationship highlighted above of inverse correlation between prices and volatility. Suppose, for example, that the options within a 10-day maturity on the FTSE index have an implied volatility of 25%, and that the 10-day historical volatility is instead equal to 18%. In such a situation, the market expects an increase in volatility on the following 10 days, which should probably translate into a fall in prices. A very interesting trend that has been observed on several markets is that the implied volatility often tends to overestimate the real risk. In other words, implied volatility often proves an excessive estimate of real future volatility. It is essentially the concept we have already talked about before. Implied volatility is not future volatility, but the expectation of future volatility. The reason why the market tends to overestimate the future risk are obviously psychological. The fear leads to seeing more black than it actually is. Studies of this kind can be carried out using implicit volatility graphs that are out of step over a certain number of days and then compared with the corresponding historical graphs of volatility that are not out of phase. This is obviously a very important result, which once again leads to preferring short-selling options to their purchase when the implied volatility tends to rise. Taking advantage of a chain of options and the Black-Scholes formula, it is possible to investigate a very particular characteristic of implied volatility. It depends strongly on the strike. The one shown below is the chain of options on the FTSE MIB index, maturity March 2015, recorded in the afternoon of February the 24th, 2015, with the index at 22,040 points. The table shows the implied volatilities of the calls and the puts calculated on the ask prices of all the options. As we can see, here we have the at-the-money options. Options with strike prices lower than the ATM tend to have higher values of implied volatility, much higher the more you get farther from the ATM. Similar dynamics show also on out-of-the-money options, but you have the most significant differences on in-the-money options. Let's put all these values on a chart such this. If we now graphically represent the implied volatilities shown in the table in previous slide, this is what we observe. The blue line is the implied volatility of puts. The green line is the implied volatility of calls. And this is proof that the put-call parity is merely theoretical. For each single strikes, we have sometimes very different values of the implied volatility of the calls versus the implied volatility of the puts. This is a very typical volatility skew. Those that appear in the figure on the previous slide are called implied volatility smiles, but in reality the smiles would be symmetrical, which is why in these cases we talk about skews. The reason for the volatility skew derives from several factors. First of all, from the asymmetry of the yield curves. The very positive returns, at least on stock indexes, are in fact less likely than the very negative ones. Hence, a higher price requested by put sellers out of the money compared to that requested by the sellers of call out of the money. Moreover, the market always tends to suffer from the so-called crash phobia. Not by chance, the skew of implied volatility is a phenomenon that has become evident since 1987, from which a greater risk is perceived towards the lower part of the returns rather than upward. However, there are other reasons as well. Since the in-the-money call options can be used to trade long on the underlying using less money, the higher volatility serves at least in part to offset this advantage. Moreover, put out of the money can be used for risk hedging purposes, and again, higher volatility serves to increase the cost of such an advantage. With regard to the out-of-the-money calls, these can instead be sold against the possession of the underlying to obtain an extra dividend. It's the covered call writing. This reduces the prices of OTM calls. In fact, implied volatility should also be high in this case because in general it would represent a premium to hedge the risk of tail events. In general, however, positive tails are less likely than negative ones. Therefore, the implied volatility is greater than the ATM, but not as markedly as on the left tail of the distribution. Once again, the market discounts the yield curve within its own dynamics. On central events, which are very likely, a low risk premium is required. On the unlikely but very dangerous tail events, a higher risk premium is required. The degree of skewness of the curves and their inclination varies over time and in relation to market conditions. Therefore, depending on the various situations, the slope and the height of the curves can be used to construct strategies. We will see these concepts later when we will be talking about strategies based on implied volatility. So far that's all. Thank you for your attention.